Have you ever looked at a stock and just thought, what am I missing here? Today, we're diving into one of those puzzles. We're talking about Energy Transfer, ticker symbol ET, a Fortune 100 giant that might just be trading at a massive, massive discount. So let's get into it. The very first thing that jumps off the page at you is this number, a 7.9% distribution yield. Now, in this market, a yield that high, especially from a company this big, is both an invitation and a warning. It makes you stop and ask a really important question. What's the catch? And that question leads us right here to the core puzzle of Energy Transfer. We're looking at a metric called enterprise value to EBITDA. It's just a fancy way of seeing how the market values a company's actual operating profits. And you can see, plain as day, ET is trading at a multiple of 8. Now look at its peers. The average is way up at 12.2, and a company like Williams is almost double that. So the big question is, why is the market putting such a steep discount on this one specific company? Well, before we can answer that, you have to appreciate the sheer scale of what we're talking about here. This is not some small-time operation. Energy Transfer is a legitimate Fortune 100 company. They operate over 140,000 miles of pipelines. Seriously, the best way to think about it is like the interstate highway system for American energy. It moves the fuel that powers our entire economy. Okay, so with that massive scale in mind, let's build the bull case. Let's talk about all the reasons why that valuation gap we just saw might be a huge opportunity for an investor. The whole argument for Energy Transfer starts with one word, stability. And this chart shows you exactly why. A whopping 90% of its earnings come from long-term fee-based contracts. This is key. They're not gambling on the price of oil or gas. They're basically running a toll road for energy. And let's just break that down a little more because it's so important. On the right, you have the typical energy company model, where revenue is tied to the crazy price swings of oil and gas. It's a roller coaster. But on the left, that's ET's world. They get paid based on the volume of stuff they move. More volume, more money. Simple as that. This creates incredibly stable, predictable cash flows, which, if you're an investor looking for income, is exactly what you want to see. But hey, this isn't just some boring, stable utility story. There's a powerful growth story happening too. ET is sitting right in the middle of two of the biggest trends on the planet. First, global demand for U.S. liquefied natural gas, or LNG, is exploding, and ET is building massive projects like Lake Charles to ship it overseas. And second, you've got the AI revolution. All those new data centers are incredibly hungry for power, and ET has already fielded requests to connect over 200 of them to its network. You've got these two massive, long-term tailwinds pushing the business forward. Okay, so a stable business, huge growth drivers. It sounds almost too good to be true, right? So why the discount? Well, that brings us to the other side of the coin, the risks and complexities, the bear case. And the single biggest source of, let's call it, confusion comes from this. Energy Transfer is structured as a master limited partnership, or MLP. Now, this is not your standard corporation. It's a special kind of company that doesn't pay corporate income tax. Instead, it passes all its earnings and the tax bill directly onto you, the investor, or as they call it, the unit holder. And for you, the individual investor, this creates let's say, a unique tax situation. It's a headache, plain and simple. First off, forget a simple 1099 form at tax time. You get a complex Schedule K-1. Now, those big, juicy distributions you receive, they're mostly treated as a return of capital, which means you defer taxes. That sounds great, right? But here's the catch. With each distribution, your cost basis in the stock goes down. And this leads to the really crucial part, step 4. When you finally sell your units, all that income you deferred is recaptured, and it gets taxed as ordinary income, not capital gains. This complexity is enough to make a lot of investors just throw their hands up and walk away. And beyond the tax nightmare, there are some pretty big business risks to consider. First, there's project execution. That huge Lake Charles LNG project we mentioned, it's a massive undertaking with real risks of delays and cost overruns. Second, regulatory hurdles. I mean, just try building a new interstate pipeline in the US today. It's incredibly difficult and expensive. And third, all this growth costs a ton of money. We're talking a $5 billion growth budget for this year. That demands perfect execution, or things could get messy for the balance sheet. So you've got this tug of war, right? On one side, a stable, growing business. On the other, all this complexity and risk. So where does that leave us? Let's get back to the numbers and try to figure this out. And that brings us right back to our original question.
After you weigh these incredible growth prospects against some very, very real risks, is energy transfer actually as cheap as it looks on paper?
Okay, this table really puts it all into perspective. Look at that EV to EBITDA row again. ED is sitting there at 8.0x, while its direct peers are all substantially higher. Now check the yield. At 7.9%, it's one of the best in the group. And finally, look at the leverage, the debt. At around 4.0x, it's not carrying way more debt than its peers. The data is pretty clear. It's not riskier from a debt perspective, yet it's valued so much lower. And really, this sentence sums up the entire debate perfectly. What's happening is the market is hitting energy transfer with a higher risk premium. Maybe it's the tax complexity, maybe it's the big growth plans. So an investment in ET today is basically a bet. It's a bet that that risk premium is too high and that as a company keeps delivering, that valuation gap is going to close. So we're left with the ultimate question for any investor looking at this company. Is that huge valuation gap a bright red warning sign, a signal of all the complexity and risk we talked about? Or is it a rare, maybe even once-in-a-decade opportunity to buy an absolute market leader with incredible tailwinds at a serious discount? That right there is the multi-billion-dollar puzzle hiding in plain sight.